Welcome to the series of those damn terms in which we try to understand a very important financial term in the simplest possible manner, that too in 5 minutes. Today we are going to learn about EBITDA. EBITDA. EBITDA stands for earnings before interest, tax and depreciation. Let's dive into an example. We have a furniture manufacturing company. Let's start by writing its profit and loss statement or income statement. For those of you who don't know what a profit and loss statement is, just imagine that as a report of how much sales the company is generating, the costs and expenses incurred by the company in the process of generating the sales, and finally the net profit that the company is deriving out of its business over a period of time. Let's start with this statement. Let's say for this period of 1 year, the company made a sales of 4 lakhs. Let's call it sales or revenue. The company incurred some costs in manufacturing the furniture. The cost of raw material like wood and other hardware come to say 50,000 rupees. The cost of labor comes to 30,000 rupees. So we have written down the cost directly related to the manufacture of goods. The simple and direct inputs like raw materials and labor costs. Essentially, we mentioned the total cost of goods sold or COGS. From the sales amount, we deducted the cost of goods sold or COGS. You get gross profit. Now the business has some more expenses. These expenses are related to the normal day-to-day business operations like rent, insurance, research and development, sales and marketing, salaries, administration expenses. Then comes the depreciation. For those of you who are not familiar with the term depreciation, let me give you a quick explanation. There is some wear and tear associated with the machinery. Say for example, a machine is purchased for 10 lakh rupees this year. Suppose the machinery lasts for 10 years and after 10 years the machine is of no use, that is zero value. This wear and tear of long-term resources like machinery is what we call depreciation, and we assign a number to this depreciation each year. The company decides that each year the value of the machinery is decreasing by 1 lakh. So this year also the company is using the machinery for the manufacture of furniture, and hence the machinery lost its value by 1 lakh. These are what we call OPEX or operating expense. This cost is just the cost of running the business. Simple. Now let's deduct these expenses from the gross profit. What are we left with? This is what we call operating profit. Then, if there are any interest payments towards loans, we just deduct those. Then we deduct the taxes paid by the business. Now what are we left with? This is nothing but net profit or earnings. The business uses raw materials, labor costs, other expenses like rent, salaries, office charges, and generates sales. There are also other factors like depreciation, interest, and taxes. To understand the final profit that the company is making, we need to deduct all these expenses from its sales amount. This final profit is nothing but net profit or earnings. But experts say that interest payments, taxes, and depreciation should not be considered because these factors do not tell us how efficient the company is in its core business. So to the earnings, they add back the interest, tax and depreciation as if they never happened. That figure they arrived at is nothing but EBITDA. earnings before interest, tax and depreciation. So EBITDA is said to be a good measure of the operational efficiency of the business, ignoring other factors over which the business has no control.